Happy Thanksgiving. I hope everyone is enjoying it with friends and family. The election is finally behind us, and we can start to see what the new administration is going to be doing. One of the key elements is this DOGE committee, Department of Government Efficiency. It's really not a department, it's an independent committee, but that goal is to try to cut down the massive $2 trillion deficit. The deficit is completely out of control. The government's bringing in a little over $4 trillion in revenues, but spending over $6 trillion. So the numbers are just staggering, this $2 trillion deficit. Unfortunately, when you look at the government's expenditures, you have interest rates expense, which is now over $1 trillion. You got Social Security, Medicare, Medicaid, all of which are pretty much untouchable as far as cutting expenses there, politically untouchable. And then you have the Department of Defense, which there's talk of actually increasing expenditures on. So I'm not quite sure where they can come up with trying to save $2 trillion, since most of that money is actually dedicated to those programs which are almost untouchable. So the bottom line is there's lots of talk about that. The dollar rallied initially, in those discussions. Gold sold off, and the fact that maybe they're going to fix the deficit. As we have said repeatedly, we think that is nearly impossible. Hopefully they can make some progress on it, but I don't think it's going to be a meaningful impact. The bottom line is we continue to have this deficit that generally drives inflation up over time. We don't think that secular change is going to take place because of this new administration. I think that is wishful thinking by the market currently, and I think as the realities bear in mind, into 2025, how difficult it's going to be to cut the deficit, we'll begin to see a resumption in inflation and also a recovery in gold prices, which sold off post-election. Gold is still up dramatically on a year-to-date basis. We did scale back our massive gold positions to just being significant as opposed to being oversized. But we do think gold is still a good longer-term place to have some money as a hedge against inflation, which we think is going to be coming back with a vengeance as we move into this continuous deficit spending, which really cannot be fixed. And I think the DOGE committee is basically going to show that it cannot be fixed. So that is a key element. Interest rates are generally driven by inflation and GDP. As you can see here on this chart, we have the nominal GDP along with the 10 and 30-year Treasury. The nominal GDP is in green, the 10-year Treasury is in blue, and the 30-year Treasury is in red. And you can see those are all basically over a very long period of time, going back to 1980, generally move in the same direction. You have a little bit of a whipsaw action as the nominal GDP went into the deep recession in COVID to begin with, and then had a massive recovery. But outside of that, you can see those generally move in line. Currently the consensus forecast for nominal GDP for the next year is around 4.2%. That would imply the 10 and 30-year Treasury should be at around 4.2%, give or take. Currently the 30-year Treasury is at 4.6%, so it could actually come down a little bit from here unless inflation reaccelerates as we anticipate. So we are working on the belief that inflation will be reaccelerating into 2025 and that nominal GDP figures will actually come in hotter than 4.2. And I think the 30-year Treasury market is somewhat discounting that fact. So keep a close eye on that. But the bottom line is it doesn't change the longer-term inflation with the new administration. The other thing I want to point out is if you take a look at this chart here with regard to the Federal Reserve and the 30-year Treasury, you can see those going back over the past 5 years. And then you can see that we had the interest rate cut where we went from a effective rate of around 5.2 down to the current effective rate of around 4.6. And you ended up having the flip side of that happen on the 30-year Treasury. The 30-year Treasury actually went up in yield 0.6%. And the reason for that is as the Federal Reserve lowers short-term interest rates, that makes money more available, cheaper, it accelerates economic activity and also accelerates inflation. So the 30-year Treasury, which is a barometer for people's expectations for nominal GDP, which is a combination of growth and inflation, both components of that actually went up once the Federal Reserve started cutting interest rates. So long-term Treasury rates went up, mortgage rates went up. So it's a very difficult situation to try to manage the interest rate environment. The only thing the Federal Reserve can really control with its monetary Fed funds rate is the short part of the curve. The long-term part of the curve is dictated by nominal GDP unless the Federal Reserve is doing massive quantitative easing, which meaning buy the long-term bonds and artificially depressing those prices. Artificially depressing those yields and driving up the price. But that's not occurring right now. The Fed has reduced its balance sheet from a little over $9 trillion down to $7 trillion. They're not on a big bond buying spree, so we're beginning to see interest rates in a more back to normal based on nominal GDP as opposed to the manipulated rates that we saw when we got down to having a 30-year Treasury at around 1.5% a few years ago. But the bottom line is, we are still concerned about the deficit, still concerned about inflation. We think inflation is going to go up, so we still think that bonds are probably not a good long-term investment. As inflation kicks in, you could have both the combination of higher interest rates, which drives prices down, and inflation decreasing the real value of those bonds, even as if the nominal value holds up. So, we continue to have asset allocation that is focused on, equities. We continue to have our gold positions. We continue to avoid the long part of the curve. For more conservative clients, we're keeping money in short-term instruments less than 5 years as a way to diversify. But we continue to believe that stocks are probably a better investment than bonds, especially in an inflationary environment. One other item I wanted to touch on is the situation with regards to impact by sector of the new administration. So one of the things to keep in mind is these policies will have to be implemented partially through Congress, partially through executive order, but it does allow for some pretty big swings in various sectors. From a positive side, the energy sector should benefit, especially in the pipeline sector and the natural gas sector, as electricity demand could easily be met with very inexpensive natural gas that is abundant in the United States. That's probably going to kick in and move toward a better implementation, especially with the demands being driven by these new artificial intelligence servers and these data serving farms that are really big energy users. So electricity demand is actually skyrocketing and expected to continue to skyrocket. So that should help out natural gas prices. The flip side of that is, crude oil prices probably continue to be a little lackluster and continue to trade in this range. The demand for crude oil has been anemic. Europe is in a very dire situation. China's recovery is not coming along as well as anticipated, and the U.S. spending has been a little weaker than most people would have thought. So the demand for crude oil has been less than anticipated. OPEC keeps on pushing back its voluntary cutbacks, so they're still not bringing that to market. So there's definitely excess supply in OPEC. So we don't think that crude prices, even in a new administrative environment, is going to be positive. The flip side is the negatives. So I think one of the biggest areas for negatives is going to be healthcare. Healthcare spending is completely out of control. It's one of the reasons the deficit is out of control. Medicare spending is completely, unbridled and going up each and every year. And part of that is the pharmaceutical companies do some price gouging. The U.S. ends up paying more for pharmaceutical instruments, drugs, than the rest of the world. It's a little crazy. We created here, the university system gets funding from the United States. We then develop these drugs, bring them to market, and then we charge more to the U.S. citizens than we charge to the rest of the world. That doesn't quite make sense. That's probably going to have some sort of continued push to get that rationalized. The other area that is in the healthcare system that there's just dramatic amount of waste is these toll takers, whether they're the insurance companies or the pharmacy benefit managers that really don't add value or quality to the healthcare experience of the patients, but just add cost and profiteering. So that area is an area that we would hope that the DOGE committee focuses on, a way to squeeze out this excessive waste. The flip side of that is the healthcare providers, healthcare industry, pharmaceuticals, HMOs have a huge lobbying effort. And they donate tons of money to congressmen's campaigns. They are in the pockets of a lot of these drug companies, and it's going to be very difficult to get rationalization because the drug companies are going to call in their payments that they've made to Congress for years. So although this would seem to be an easy place to attack, the fact that the congressmen are so corrupt and have been corrupted by the campaign finance rules basically makes this a very difficult task. The other area that's taking a hit and that should potentially have some issues is the focus on food quality, additives, the fact that the U.S. diet has gotten so bad, not enough fresh, real food, too many packaged foods. So a lot of the food companies' stocks have sold off, and we would continue to think that's going to be a problem, especially if they have to reformulate some of their products. And the world starts to realize, the country starts to realize, given the focus on it, that they need to eat a lot better. And we've already seen a significant pullback in gold after a huge run this year. Gold is still way up on a year-to-date basis, but since the election, the possibility that the DOGE committee is going to fix the deficit has caused gold to sell off. As I mentioned, we don't really think that fixing the deficit is something that can be done, and we would anticipate that gold over a longer-term basis is going to be good. It could continue to sell off if this DOGE committee gets a lot of press and traction, people start to worry about it more. But I think in the end of the day, they're going to realize that fixing the deficit is really not something that can be done, and that gold should be a good holding. The other area that's going to have a lot of problems is the subsidized green energy area, whether that's windmills, which really don't make any sense either from electricity production or from an environmental standpoint, since they kill a lot of birds and whales and dolphins, is the wind industry should begin to suffer significantly. The other area that is going to be a significant impact is electrical vehicles. The only way to make those really affordable for the mass market is through significant tax credits, and those tax credits are in danger of being pulled given the deficit situation and the fact that electrical vehicles still need to have electricity produced, and that electricity is not being produced in big sources by green energy because green energy is not very efficient. Windmills are very inefficient. Solar is more efficient but is also weather determinant. And so you have those issues where even on electrical vehicles, you're still using either natural gas or coal to fund this new electricity demand. Natural gas is the cleanest, has the lower carbon footprint versus coal, so that is probably the best way to go environmentally, but you don't have the ability to produce electricity really from strictly green sources like solar or wind, which is really not a green source. It's an environmental boondoggle. But we're beginning to see that those areas are going to have some problems as the new administration cuts costs and also de-emphasizes tax subsidies to make those things possible from an economic standpoint. I hope you find this update helpful. Hope you enjoy the Thanksgiving holidays. This has been Halliburton, and have a great day. Thank you.